Wow, hey, today we're talking about something incredibly exciting, a little bit stimulating, and certainly mind blowing. What is it? Institutional investors. Come on, let's check it out. Hey, Dave Edwards, Treasure Valley Dave, and today we're going to talk about institutional investors. There's been a NAR report, National Association of Realtors, that came out, did a real in-depth study on that. Yeah, there's some boring bits in it, but there's a lot of good information that's going to help us understand what's going on in this crazy world, at least the United States, right? So let's get to that. But first, I wanted to remind you that if you think that the Treasure Valley, Idaho might be the place that you're considering moving to, give us a call, text, email. We've all made that relocation journey as well, and we've got answers for your questions. We've got resources. We've got things to help you figure out if this really is the place or not. And we're always very happy to help you guys out. Another thing is that if you like this video, please go ahead and like it. If you haven't already, please subscribe to the channel. We have a lot of great fun things that we do with our subscribers, contests and stuff like that. So we want to make sure that you're in the fold there. And then also maybe share this with somebody else that needs to see it. So, and if you could go to our website and check it out. We've been working on it pretty hard. Aaron's been busting his hindquarters on this, and there we have a lot of great information over here in the resources tab. So we have like magazines and flyers and fact sheets. And if there's some question that you have that we haven't answered here, let us know. We'll put together a fact sheet for you and answer your question, and then probably a bunch of other people as well. So let's go ahead and get right down to institutional investors. Wow, institutional investors, they have a big hand in what's going on in this market, this country, and let's just get right down into it. So this is a study by NAR, came out in May, and it's data from 2021. So, it's not the most current, but I think that's going to be an indication of something that we'll get into in a little bit. Impact of institutional buyers on home sales and single-family rentals. And if you'd like a copy of this, it's a 50-page PDF. Let me know. I'll see if I can't get that out to your email. Be glad to do that for you. And I'm going to just kind of go through this and hit on the highlights. There's just tons of information in here. But some of the key findings that they have here is that institutional buyers made up 13% of residential sales in 2021. And the median purchase price of institutional buyers is typically 26% less than the state's median sales price. And we'll see a little bit more why that is. Hint is that because they bought a lot of homes that needed to be fixed up. So also, in counties where investor share was higher than the national average, listings were down 7%. And in counties where investor share was lower than the national average, listings were down 4%. So here's some more information. In counties where the investor share was higher than the national average, listings were down 7%. And in counties where investor share was lower, then the listings were down 4%. So where there was more investors, there was less listings. I wonder why. Maybe because sellers went straight to the investors and they never made it to the market. That's possible. Also, the median price of properties purchased by institutional buyers in 2021 was typically 26% lower than the state median prices. I think we just covered that. And that's probably because they were purchasing home, like it says right here, that needed some repairs. So some more things that they learned from this survey was institutional buyers tend to purchase in these particular markets where there is a rising household formation, strong housing and rental markets, high income markets, and also markets where there's a high density of minority groups, especially black households. Kind of interesting, huh? And the implication is that while institutional buyers who purchase existing homes to convert to rental provide rental housing, this takes away stock from future homeowners. And I guess that's true too. It's like if you don't have the houses to buy because you turn them into rentals, and you don't have houses to buy. And as most of these houses were being bought by the institutional investors were being fixed up, those houses at the lower end of the scale weren't available for maybe people just starting out. Maybe they could put some little elbow grease into their house, and those just houses weren't there anymore. And this is the survey revealed that the main impact of institutional investors is on market competition. So what does that mean? It's like, well, maybe they take the houses off the market before they even go on the market. And let's come down here to market share of institutional buyers. This is kind of interesting. The states with the institutional buyer market shares, or they missed a word here. It's a little typo. The states with the highest institutional buyer market shares were Texas, Georgia, Oklahoma, and then the ones that saw a decrease in institutional buyers were these down here: Maryland, Delaware, and Virginia. And again, they're telling us, I guess they really want us to know this, the median purchase price amongst institutional buyers is typically 26% below the median price. Kind of a visual thing here is that this is Texas, Georgia, Oklahoma, and Alabama had the highest fraction of purchases by institutional buyers. So Texas, they had the most, and at 28. And then you can come down the list over here: Georgia, Oklahoma, Alabama, Mississippi. So over here in Idaho, we're still blue. We don't have that many institutional investors. Kind of weird, huh? So if you're sitting in California thinking, or Oregon or Washington or anywhere as far as that goes, I want to go to Texas. Well, there's a whole lot of Texas, right? But there are some certain areas, and we'll get into those areas in a little bit, that maybe you don't want to go to because the institutional investors are there and there's not rentals anymore because the institutional investors have bought them up. Okay, let's go back to the beginning of just this slide here. So Texas, Georgia, Oklahoma, and Alabama had the highest fraction of purchases by institutional buyers. And we can kind of get a feel for that from this map. Texas at the highest at 28%. And then we come down, as you can see over here, to Georgia, Oklahoma, Alabama. And up here in Idaho, you can see that we are among the lowest parts of where institutional investors went to. So if you're sitting out in California or Washington or Oregon or some other place, and you're wondering, hey, Texas looks really good. Well, I want you to be aware that that's where the institutional buyers have really focused as well. And we saw earlier some of the things that institutional buyers are looking for, and maybe that's the same type of thing that you're looking for. And if it is, more power to you. But if it's not, I want you to be aware of that and to know that Texas is where you're going to find it. Idaho is where you're not going to find it. So let's keep going along. And now we're looking not just at states, but counties that have higher institutional buyer share than the national average. And you can see most of the West out here is all very low institutional buying. Over here in Texas, it's huge, particularly certain parts of Texas. But also look at Canyon County. We turned a little tiny bit orange there. And as we go through this report, you will see Canyon County's name come up a little bit. So let's keep going. We can go past that one. We can go past that one. There we go. Built for rent, one family housing accounted for 5% of one unit housing starts in 2021. So that means single family houses. It could mean a townhome or something like that. Someplace where there's one family moving in, and 5% or 1 out of 20 was built just for becoming a rental. And we'll keep coming along. Market conditions that attract institutional buyers. That's what we're talking about now. 10 factors that attract investors to a market. And so the areas that share with a share of investors higher than 30% have these factors. Where households grew 11% on average. There we're talking about the minority, again, here it says black households is 16% on average. 30% of households are renters already. 27% of households, so just a little over a quarter are millennials. Households earn about $59,000, and 12% of the residents moved within the past year. And home prices rose more than 40% in the past decade. I'm not even sure if that's a starter right there. Rents have increased more than 30% in the last decade. Home sales rose about 70% on average in the past decade. And vacancy rate is 15% on average. Now that's kind of funny. Over here in the Boise area, Treasure Valley area, our vacancy rate is around 3. So 15% vacancy rate seems awful high. So maybe that's why they have some over here in Canyon County, but not everywhere else. So this is fastest household formation. And some research that I've done here is in the areas with a share of investors higher than 30%, the number of households grew by 11% on national average. So, the category is fine, but what I'm looking at over here is so Williamson County, that's the Austin metro area, that's 2.4 million in that area. And Denton County is Dallas-Fort Worth, 7.6 million. And Collin County is also the Dallas-Fort Worth metro area, and that's also 7.6 million. So these are major population centers. And higher density of minority groups. Again, I'm not so much worried about what the category is, but I'm just looking at where investors are looking at. Clayton County, so this is the Atlanta metro area. That's 5.1 million people. Douglas County here in Georgia is also the Atlanta metro area. Again, 5.1 million people. And Bibb County, Georgia is the Macon area. And it's 234,000. So this is a smaller area. But apparently there's a big reason for renters there. Maybe there's an Air Force base or something? I'm not sure. Higher density of renters. So we've got Clayton County, again, is the Atlanta metro area. And the share of renters here is 46%. Amazing. Dallas-Fort Worth area is 50% renters. Share of investors, 43%. Wow. I mean, these numbers, can they even be right? This is the Austin area here in Travis County. And again, at 2.4 million. So these are all like mega millions of people in these areas. Higher density of millennials. And so a millennial is someone that's between the age of 25 and 40. I had to look it up just to be sure. I mean, we've all heard the phrase, but I wanted to be sure to make sure you guys had proper information. More millennials are here in Midland County, and that's where Midland is. 176,000 in the Midland area. Travis County, this is the Austin area, 2.4 million. Nashville, 2.0 million. And what do we have down here? Higher income and education. So over here in the Austin area in Travis County, again, 2.4 million. They have more people with bachelor's degrees. I guess that makes sense. Isn't Austin kind of a college town? Denton County, this is the Dallas-Fort Worth area, and that's 7.6 million. And Williamson County is the Austin area, 2.4 million. Many people moving in the area. So again, Travis County is Austin, 2.4 million. They had 22% were movers. San Antonio area here, and that's 2.6 million. And Pima County, Arizona, that's a Tucson area, and that's 1.0 million. And fast has household appreciation or home appreciation in affordable areas. And we see the first time of Canyon County. So of course the biggest city in Canyon County is Nampa. And so let's compare apples to apples. So the entire Treasure Valley, Boise metro area is 750,000 people. But I don't want you to be scared off about that. So the whole Treasure Valley is 750,000. Ada County, that's Meridian, Eagle, Boise, that's 470,000. Out here, little Canyon County, as we're seeing up here on the screen, we're at 224,000 according to Mr. Google. And so that's not so bad. I mean, where you're looking at some of these other places at 5.6, 7 point whatever million, 7.6 for the Dallas area. So if you're saying, well, I want to move to Dallas or Nampa, there's so many differences. I mean, 7.6 million people in a small area, or Nampa, we got a little over 100,000 in an area. So it's like, Midland, Texas, we said is about 176,000. So you could maybe say that's comparable to Canyon County. But then we have down here Dallas at 7.6 million. We have, in this case, we have higher home appreciation. And I think a lot of that, I don't know what's going on in Texas, but I know what's been going on in Canyon County is that we have been undervalued for so long. This is where people would come up here and make fun of getting such a screaming deal on a house. Well, house prices came up because people started to become familiar with our area and started to move here. Maybe because they didn't want to live in places where there's 7.6 million people. Fastest rent growth, where's that been happening? That's been over here in the Dallas area, 7.6 million people. Also in the Nashville area with 2 million people. And over here in the Atlanta metro area with 5.1 million people is where rents have been going up. And that's where investors have been going, these institutional investors. Fast home sales growth. Again, Canyon County. Here in Nampa area. And Williamson County, again, that's Austin at 2.4 million. In Duval, Florida, that's the Jacksonville area at 1.6 million. So I just wonder, we'll talk about that in a minute. So here's Tarrant County. This is the Dallas-Fort Worth area. As we look at lower vacancy rates, vacancy rate of 7%. Canyon County, here we go, 4% here. I want to say it's, well, maybe they're counting everything. But if you're looking at houses, it's probably closer to 3%. But if you're interested in a rental, either becoming a landlord or you're just looking up here to rent, I've worked with some really good property managers. Give me a holler. I'll get you all connected with them. And then down here is Dallas-Fort Worth area, again, at 7.6 million. Can you even imagine that? I mean, that's more than 3 times, almost 4 times the size of the population of the whole entire state of Idaho is just in this one metro area. Amazing. Of course, I mean, if you're in LA, this is probably nothing for you, right? So market impact of institutional investors on home prices or purchases and single family rentals. So this is some interesting stuff, right? The survey noted that institutional buyers can take several business forms such as, but not limited to, shared equity ventures, rent-to-own programs, traditional REO, it's real estate owned, short sale buyers, or instant buyers or iBuyers. So iBuyers are institutional buyers that make up an instant cash offer based on a home's valuation models to determine the value of a home. So let's just take a moment and talk about that. So we had, Zillow's going out purchasing and other iBuyers were, and they had their automated valuation algorithms. And they were saying that, hey, price is supposed to be doing this and this and this. And everything was great when prices were going up. They were coming in. They were buying a large percentage of their houses to flip, maybe go in and put a coat of paint on and new carpeting. And they were also buying a lot of them to hold as rentals too. But they were all basing this on their algorithm. Well, their algorithm didn't turn out to be half as smart as, a room full of realtors. As soon as the market even had a hint of that it was changing, you saw some of the big iBuyers, they were just bailing out and taking huge corporate losses on that. Impact of these institutional investors on home sales. So 15% of single-family home purchased in 2021 were institutional buyers. And 42% of the single-family purchases were institutional investors converted to rentals. And it says that they didn't drive down or change the price or drive up the price. They're just being very competitive. But then again, can we really say that? Because prices were going up in 2021, like a rocket ship. Am I right? Do you remember? 50%, 56% of the sellers said that they sold to these iBuyers due to cash offer or as is sale. So they just wanted to dump their house, the convenience, not having to have people buyers come through their house and open houses and stuff like that. So apparently that was pretty appealing to a lot of people. This is something else too, that institutional investors offered an array of affiliated services like title, mortgage, financing, home inspections, and things like that. Do you remember back when you could see all these ads like, we'll sell your house for 1%? Of course, the devil's in the details there, right? So it wasn't 1%. It was 1% plus you had to pay for the agent that brought the buyers. Plus you had to pay for fees for their affiliated companies, their title companies and things like that, and maybe their handyman or whatever. So they had their people that they work with, and you as the seller who thinks, oh, you're getting out with just paying 1%, it didn't really work that way, because they had all these affiliated companies that you were, I don't know if you had to use them or just highly encouraged to use them, but unless you've been through the process several times and have inside information, maybe you didn't know what you could do and what you could refuse. This I thought was interesting too, is 4 years is the average length of stay in a single family home rental before you move out. Alrighty, let's just keep moving along here. Institutional buyers accounted for 15% of single family purchases, and 42% of single family properties purchased by investors were converted to rentals, and 45 were sold back. So, or flipped is basically what it is. Oh, see right down there, flipped. So when they bought them, they would flip them, and because back to their algorithm, it said the price is going up. So we could go in there and do these little things, because flipping used to mean that you have to buy a house at dirt cheap, come in and do a lot of work to it, and then get it presentable, and then put it back on the market. But apparently they could buy houses and then turn around and sell them back. Maybe they fixed them up, maybe they didn't need to, maybe they would just buy them from a seller who needed to have the convenience of a fast sale, all cash right now, not have to worry about it, and even though it's at a lower price. Then the algorithm says, hey, prices went up, and prices were going up, remember? And then they could sell it and make a profit. And then some of them they turn into rentals. So is that good or bad? Well, let's keep going, because guess what? The survey actually answers some of those questions. No price difference on the purchase of homes, either by regular buyers or via these institutional buyers. And this is some of the reasons that sellers preferred these institutional buyers, because they got cash out of them. They could just sell it as is without having to fix them up. And they like the idea that they could sell on a specific date and they have everything wrapped up and it's good to go. And here's some of the services that institutional buyers offer to the sellers. Option to lease the home. This is something that we were doing, all the time last year and earlier this year, even somewhat now that the market has changed, is that the seller can still stay in the house for some period of time after close, so they can find their next house, or they can move, or whatever it is they needed to do. Services also provided by these iBuyers where they would fix the home. Well, if you're the seller, and we have people, we have handyman, we have tradesmen that can come and fix your house, and depending on what it is, they can also get paid at closing. Not too long ago, we had a roof put on during the escrow process, and the roofer got paid. It's like the same thing here. There's no money out of the seller's pocket. It all comes at closing, and without having one of these institutional buyers come in, we could do that to you with just regular buyers. It's really good to work with a experienced real estate agent, because they can help answer some of these things that you might be leaving too much money on the table. And home cleaning, if you need a great home detailer, I got your guy. Institutional investors offer these affiliated services, title, mortgage finance, home inspection. And so these are where, obviously they're not going to, these institutional buyers aren't going, or even the sellers aren't going to make all their money off of your 1% commission that they put in their advertising. They're going to get it back somehow. And I'm going to just guess that some of those ways are having you use these different affiliated companies and charge you fees for these, maybe fees higher than what you'd have to pay if you had your choice to pick someplace out. And scrolling right along, we find that higher rent on institutional investor properties compared to mom and pop rentals. There it is. So institutional buyers come in, they get the house, they turn it into a rental, and then they charge more. And how can they do that? Why wouldn't renters just go to the mom and pops? Well, because there isn't that many mom and pops anymore, because these institutional buyers have come in and bought up the houses that like first time buyers would get, and also what mom and pop investors would get. And so those aren't there anymore. So these institutional people, and what are they like? I don't know, you've heard them. They're always associated with these big Wall Street hedge funds, speculators, and things like that. They have, billions of dollars, and they saw that maybe the market wasn't the greatest place to be. Maybe COVID had scared all these institutional investors, but they saw real estate was a good, safe place to be. And these guys are no dummies. So maybe we could do what they do. And let's see, what else do we have going on here? Single family home renters rent for 4 years on average before moving out. But it looks like the big years that 10% of them stay for 1 year, 26% stay for 2 years, and 25%. So it looks like most of them are out by the third year, huh? Which is a long time to rent, I would think. I mean, maybe you need to get your financial history all put together so you can get the best possible rate to get a mortgage. Maybe you're saving up for down payments. You have enough to put down so you don't have to get the PMI on your mortgage payment, something like that. But I don't know that I would want to be in a rental any longer than I had to, because even though like right now our market is kind of slowed down, even gone down a little bit, Idaho's on sale. Idaho's on sale. Idaho's on sale. Idaho's on sale. We told you that prices will be going up. I heard Dave Ramsey say this the other day, and he's a smart guy. He didn't get to where he is today by being stupid, am I right? And he said in 5 years, housing is going to cost more. In 5 days from now or in 5 minutes from now, it might not cost more, but in 5 years, it's going to cost more. So if you buy now, in 5 years, you're going to look like a genius. Maybe Warren Buffett will give you a call and ask you for advice. Okay, maybe not. Well, he might call you, but I'm pretty sure he's not going to call me, right? And let's see, single family rentals were occupied by households headed by 25 to 44-year-olds. So I guess that there's the big sweet spot for people renting houses. That was our look at this institutional buyers and what they've done. Just in a quick summary, all this money has come in outside of the traditional buyers and sellers as far as that goes, and they have bought up a lot of property, and they need to have a good return on these things, and so they look for particular areas where they're going to get that return, and then other places they didn't go. In places that they have gone, rents have gone up, house prices have gone up, and it looks like it's harder for people to buy that entry-level house because it's already been bought by institutional investors, so now they're going to be a renter. We saw that Idaho, the Treasure Valley, we don't have that so much. Canyon County showed some of it, and that's true, but we're still nowhere even on the radar as compared to many places in Texas. And I'm not saying that it's still cheap up here, not like it used to be, but put your plan together, get with a lender, figure out your strategy for buying your house, get with us. Prices have come down. Builders right now are offering fantastic incentives, and even $20,000, $25,000 to help you buy down your interest rate. You might pay this for a house, but it's going to feel like this when you're making your payment because the builder has helped you buy down the interest rate to a place where it makes your monthly payment a lot less stressful. And remember, if you're thinking that Idaho might be the place for you, please give us a call, text, email. Glad to help. We've all been through that same relocation journey as well. And also check out our YouTube channel, which you're already on, And make sure that you've subscribed. That helps out so much. And then like this video and maybe share with somebody else that needs to see it. Well, thanks for coming by. And as always, this is Treasure Valley Dave, looking forward to helping you get home.